Daniel Crosby, the behavioral investor. Embark on an insightful journey through the world of investing with the book summary of The Behavioral Investor by Daniel Crosby. This summary explores the intricate role our brains play in making investment decisions and sheds light on why our decisions often fall short. Delve into a wide range of factors such as emotions, intuition, overconfidence, fear of market bubbles, and our preference for the familiar, as this compelling summary helps you understand these influences and paves the way for more strategic financial choices.
Understanding the brain for successful investing. The success of an investor depends on the understanding of how their brain works. The brain is wired to avoid risk and seek immediate rewards, making it difficult to make good financial decisions. Being aware of these impulses can help investors overcome them and achieve long-term gains. The stock market is driven by investors who make decisions to buy, hold, or sell. While many people believe that money is what drives the stock market, the focus should instead be on the people who invest that money. Unfortunately, many decisions made by investors are based on emotions rather than logic, as the brain struggles to work in complex and stressful situations. The human brain was designed to keep our prehistoric ancestors safe, and it still reacts as if we are facing mortal danger when assessing financial risks. This limits our ability to think clearly and can cause us to overlook important information. Additionally, our brains are wired to seek immediate rewards, even if it means sacrificing long-term gains. This impulse to chase every opportunity to make a quick buck can lead to poor financial decisions. The desire for money clouds our judgment, making it difficult to resist the promise of reward. To be a successful investor, it is important to understand how the brain works. By being aware of our brain's impulses and tendencies, we can overcome them and make better financial decisions. It is essential to prioritize long-term gains over immediate rewards and resist the urge to chase every opportunity. The key message is simple: to succeed in the stock market, investors must first understand their own brains. The irrationality of human behavior. The stock market is affected by the weather, and it turns out, our behavior is heavily influenced by our feelings. Instead of pretending to be entirely rational adults, we need to accept the truth that we're not. When it comes to making decisions, we are experts at justifying our choices and demonizing the option we didn't choose. Despite this, our ego-driven need to maintain our self-identity makes it difficult to change course if a decision doesn't work well. Even when faced with the potential for gain, we prefer the familiar, leading to strange situations like a community choosing to rebuild their town in an impractical and unattractive way. To succeed as an investor, we need to accept that the market is always changing, and we will face potential losses and regrets. It's time to move forward with the best course of rational action instead of letting our emotions keep us stuck in the past or paralyzed by fear. Overconfidence in investing. Overconfidence can be detrimental to one's success in investing. When investors experience a win, they may think it's due to their unique skills, leading to ego-driven behavior that causes them to keep buying even when stock prices are already high, going against the buy low, sell high rule. On average, investors overestimate their yearly returns by 11.5%, highlighting that they are not as skilled as they think. Overconfidence is also the reason investors fail to diversify their portfolios, thinking they have found a sure winner. However, diversification is crucial as it reduces the odds of catastrophic loss and is useful in making market predictions. Seeking predictions from sources that use different forecasting methods can benefit from the crowd's wisdom, leading to informed decisions. To be a successful investor, leave your ego behind and accept that the market involves lots of uncertainty and a fair amount of luck. Embracing the unfamiliar. Discover why embracing the unfamiliar is key to successful investing and how human tendencies can put portfolios at risk. The Mona Lisa is considered a work of artistic genius, but it was not until its theft and subsequent media sensation that it gained widespread attention. Just like the human tendency to value what is familiar, investors often default to the stocks they know and overlook international opportunities, putting their portfolios at risk. To invest successfully, it is essential to embrace the unfamiliar and construct diverse portfolios to weather financial uncertainties. The split of equities in a portfolio should correspond with the size of each country's market, but investors tend to overinvest in domestic stocks due to a preference for the familiar. This home bias can prove costly in the event of a disaster and means many miss out on international opportunities. By accepting that upheaval is inevitable in the financial world, investors can become behavioral investors and build diverse portfolios to navigate natural highs and lows. The behavioral investor. In the 1690s, colonial Massachusetts was engulfed by a witch panic. The ridiculous procedure for trying the accused led to a damning verdict regardless of the outcome. This fixation on limited information that ignores other relevant data is what makes us invest poorly. To become a successful investor, we must broaden our views beyond emotions and probabilities, examine portfolios, diversify, and trust the test of time. Mastering emotions for successful investing. Dr. Watt Smith, author of The Book of Human Emotions, discovered over 150 emotions that can impact financial decisions. Emotions can combine to create complex secondary feelings, which can lead to bad investment decisions. To invest successfully, one must manage their emotions. Meditation is seen as a valuable tool for investors and can lead to more considered decisions by lowering activity in areas of the brain that control greed. Therefore, paying attention to emotions is essential to know when to be guided by them and when to regulate them. Trusting your intuition in investing. Think again. Our intuition plays a significant role in influencing our decisions, but when it comes to investing, it could take us down the wrong path. Our conscious mind, despite being able to make simple decisions, might not be the best tool for making sound investment choices. Making decisions with outcomes that are unpredictable and getting quality feedback for the same is difficult in capital markets. As an investor, one should not rely on gut instincts but rather turn to model-based approaches like using extrapolation algorithms, which perform even better than humans 94% of the time. It is crucial to understand how little processing power our brain dedicates to conscious decisions, and to be successful in investing, one must accept that conscious thinking isn't always the best decision-making tool. Mastering market bubbles. Bubbles are a natural part of capital markets, but to be a successful investor, one must learn to manage the fear of them. By creating a rules-based system, such as a momentum-based model, investors can focus on being patient and acting infrequently, rather than reacting to emotions. Lengthy periods of inactivity may seem counterintuitive, but they give investors time to shift the odds in their favor.
In conclusion, The Behavioral Investor takes you through the fascinating realm of human behavior and its impact on investment decisions. Understanding the workings of your brain, managing emotions, and keeping overconfidence in check are key aspects to becoming a successful investor. The book emphasizes the importance of diversification, avoiding confirmation bias, and adopting a model-based approach to decision-making. Embracing the unfamiliar, staying mindful, and dealing with instinctive reactions appropriately can help you navigate volatile market scenarios and make wiser choices for better long-term gains.